Hi, welcome to Tangent. I'm Edward Cohen.
I am Jeffrey Berman.
Today on Tangent, we have Cory Sylvester, co-founder and principal at DXD Capital, where he's building and investing $500 million in storage across the US. Cory previously bootstrapped a seven-figure self-storage data company called Radius Plus. Hi, Cory. Where does this podcast find you?
Morning. I am in Connecticut this morning.
And it appears that he, much like you, Edward, has fantastic internet. Well, I do not. And thus, I am not on video. So you can see a wonderfully airbrushed photo of me. Almost too airbrushed.
It looks great.
Thank you. That's what I was fishing for.
Yeah.
Jeffrey, that looks better than Midjourney or DALL-E 2. So it's a good image. You've always had a voice and a face for podcasts. So we appreciate your presence here. Cory, lots to talk about. We are going to talk about today about self-storage, the least sexy yet arguably the best asset class in commercial real estate. Tell us, what are you seeing on the market? What's some of the industry trends? What's the investor and developer sentiment right now?
Investor sentiment is shifting. You know, if you think about what's happened in self-storage across the last 3 years, you had a big run up in demand from COVID. You know, we really didn't know what COVID would do, and what it ended up doing is creating a lot of demand from people, you know, needing additional space in their homes and a variety of different reasons. It pushed up occupancies and rates across the country rather ubiquitously everywhere. And then, you know, the last couple, I'd say 12 to 18 months, you've seen kind of a cooling to a certain extent, although the run up that we saw from COVID, you know, we've kept probably 70% of that run up. So we look at like core fundamentals, occupancy and rates in the industry, they're still very high. And if you look at the previous cyclical peak of the industry, which was in 2016, we're at those 2016 levels. So the industry from a health standpoint, from occupancy and rates, we're looking still very strong. You know, people get a little distracted from the fact that we're down off of 2021, 22 highs, but from a holistic standpoint, it's still very healthy.
In terms of, you know, calling a commercial real estate asset class resilient, I think if we don't talk about self-storage, then, you know, we're doing a disservice, because get this, there are over 50,000 self-storage facilities in the US. That's more than Starbucks, McDonald's, and Subway restaurants combined. So that means with an average of 546 units per facility, the US has over 27 million storage units. Should be called the United Storage of America.
Canada has self-storage similar to US, less penetration, I'd say, but a little bit in the UK. Australia has some, but it is a US phenomenon.
Because we love crap. I'm gonna throw a tangent in already, because this is so frustrating for me. I have Edward, when this goes live, I want you to bleep out this number, because this is embarrassing. Just bleep out the number, but the whole sentence should say,
I can already tell you've got many storage.
Cory, I have beep vaults of storage with furniture, clothing, just crap that I will never use again. And this is a conversation with my wife that I beg. She says no. I stop begging. And then I bring it up again because I spend a fortune on it.
Yep.
And lovely folks like you know, you guys got to eat too. So I get it. Like, that's great for your business. But you know what I wish there was? I wish there was a service within storage that somehow could become a middleman, and using software to do this to help people get rid of their unwanted stuff. Just to even, like, I'll give you an anecdote. So we moved from New York to Florida, and we have a lot of our New York stuff in this Florida storage unit. And I wanted to, we had, Edward, get ready for another bleep. We had about 5 vaults, and I got them down to 3 because we gave literally tons of stuff away. But of course I did it completely wrong. I didn't know how to do it for the tax donation. So we ended up giving away a substantial amount of really nice furniture, et cetera, without being able to take the tax deduction. And the storage facility was no help at all, which again, it's not in their purview to do so. But for the love of God, just one tiny man's plea. Cory, help us out. Build some software for this problem.
I don't think I have the economic incentive to build the software to solve your problem, but I do offer a product that solves your problem at every facility we have operating, which is a giant dumpster in the back.
Boom. Actually, low tech.
It's a low tech solution.
No, but there's, I think a lot of people, and I think you're right. I think this is a uniquely American problem because we are an extraordinarily consumerist society. And we're also like, what was that show? It's on some network, like Hoarders or something like that. We end up holding
Stars, Storage Wars.
Yeah, all of this stuff. And I feel like it's wasteful, and there has to be some solution from both the philanthropic side and maybe from the storage side, because you could have an economic incentive. Imagine if I said to you, Cory, figure it out, and you can have 10% of the proceeds. All of a sudden, that might be worth something.
The element that you're getting to, though, it's if you look at those hoarder shows, it doesn't actually come down to the stuff. It comes down to the emotional connection that people have with their things, right? So you're getting at the core element of what makes storage such a sticky product. And let's just bifurcate. There are real economic value. There's economic value of a plumber using it as a distribution site to put his inventory in, pharmaceutical companies using it. And going back, Edward, to your resiliency, is there are 100 different reasons why people do use storage. Transient people needing to store temporarily, because 50% of the people only stay less than a year. So there are people that use it for a temporary dynamic, but the long tail customers, the customers that make us the most money, are Jeffrey or people like you, which put it into storage and have this emotional connection. The economics don't make sense as it relates to what you could buy the same goods for and replace them with, but ultimately there's this element of the friction of not being able to get rid of it for emotional reasons, for a whole host of other reasons. But that's what ultimately keeps people from throwing the stuff out, because you could do the math for them all day of this does not make sense to continue to rent these things. People rent them for 10, 20 years.
Right. I don't want to throw it away because I find that wasteful. I want someone else to use it. We have beautiful, beautiful things that we will never use again. And I'd rather give it to a charity, but the charities themselves aren't even set up for it. They're like, well, you have to catalog it. You have to do this, that, and the other. I'm thinking to myself, well, if you're going to make it impossible for me to give you things that are incredibly valuable, I'm not going to do it.
Yeah.
I have a day job.
Thus, the industry is well suited to do well into the future, because I don't know of any products yet that are going to solve that.
Agree.
Forget about Cory. We need to book Jeff with Marie Kondo ASAP. Now, talk about the largest monthly subscription that most American families have, which is self-storage, right? I think the average is right now around $180 a month. We have over 1 in 10 US families using self-storage. So if you look to your left and look to your right and your family's in there, they're probably at the self-storage unit. Now, Cory, you want to talk about your businesses, because you have run a 7-figure SaaS business called Radius Plus, which I got the fortune of using during my early days at Neighbor. You guys have some great comps across the nation for self-storage facilities. And now you're building a 9-figure real estate platform. How are those two working in tandem, and what's your vision there?
They're arm's length companies, meaning they, I own a Radius Plus with 2 other partners, and DXD was actually with a customer. I started DXD with a customer of mine at Radius Plus. But the idea was, I got into storage I used to be in the investment world. I was at a hedge fund, and we started an advisory business. That's originally what the Radius Plus, the legacy business was, is we were advising hedge funds, and self-storage was just the first industry we came across where we found a big thesis, which was in 2016, was to short the stocks. So we never actually shorted them ourselves, but we were advising some of the largest hedge funds in the world that there was a bunch of supply that was about to come on, and so you should short them. Through that process, found out that there was a lack of information that the industry needed in order to make investment decisions to buy a facility or develop a new one. And so we built the technology and ultimately, grinded for several years to build the first in only supply data set of where is every facility, how large is it? And then we started adding in, okay, let's track every single rental rate that's out there, track the developments, integrate demographics. And so that was Radius Plus, and kind of found ourselves in a different business model than we ever expected when we started, which is, not uncommon. As I'm learning, when you start a company, you don't really always end up in the path that you originally sought. From that, really got a very granular understanding of not only the data, but how people think about developing self-storage, and thought that there was a better path that was not as typical as it relates to how developers thought, which was, self-storage rates function a lot like airline rates, in that if you find a really high ticket price from Denver to New York City, you don't really need to know the occupancy of that airplane to know that there are not a lot of seats left, right? Same dynamic as it relates to storage. Prices are very dynamic. They use the same pricing methodology. So to the extent that you use price as your real indicator of where you should go build, like that was the concept I thought we should pursue. And so called a customer of mine, or Radius, and said, I think that we should start a development organization, which now we're buying them as well, under the premise of using this as our investment methodology. And we started DXD in March of 2020. So a little bit of a interesting time to be starting a real estate private equity company. But that's the premise of DXD, is that we're using data kind of unconstrained from how normally people were thinking about developing self-storage, and that we came from an outside perspective. My partner on the DXD side has developed for 20 years, so he has that development experience that I lacked. But we really came at it from a data standpoint to look at it from this, what is the best indicator to use, and how should we think about these things dynamically and without the constraints of how people have always thought about it. And that's what's made us successful at DXD, is that, we've taken that approach and doubled down on it, and it's done well for us.
That's a fascinating journey from a recovering successful hedge fund professional to data storage, data-driven
recovering
investment.
Hedge fund professionals. It's successful is a debatable.
Recovering, confirmed. Now, Cory, I don't know if it's a coincidence that the company is called DXD, when the famous Ds that drive the demand for storage were downsizing, divorce, death, and can't remember the other D, but quite fitting. So talk about some of the self-storage facilities that you're investing and developing. Where are they located? What size are they? Are you looking at any office to storage conversions?
A quick answer is we're developing in Hawaii, and we're developing in Rhode Island, and everywhere in between. Normally when you read an investment deck, it's like, these are the areas that we're targeting, and these are the MSAs we're trying to target. And I hate that constraint when you start an investment thesis. We started from the standpoint of, when you develop, it's a pretty simple equation. You have your rental rate, you have your cost to build, you have your operating expenses, you have your property taxes, and you have your land basis. And so you can reverse engineer based on knowing what your property taxes are in an area, what your general land cost is going to be, what your construction costs, to what the rental rate needs to be. So we use that rental rate as the determinant of where we go and we build. It ends up being a lot of the places that you would see in those decks of, Sunbelt markets, and some infill in the Northeast, but, some of the Western markets as well. And, that's done very well for us. So using that as the basis to figure out where the best sites are. Office conversions, we have looked at several. There's some that work. They can be complicated in that the zoning can become difficult, and the floor loadings are something that you don't always have an office building that can withstand the weight of what a self-storage facility would require. And there are definitely opportunities out there. We've looked at them. We've bid on a few. I think there'll be more, but at the same time, filling up a 300,000 square foot office is not conducive with the model that we take, which is, generally in LA or New York City, you can build 200 plus square feet of storage. That's a much rarer occurrence than what you normally build, which is, on the high side, what we're building is 150,000 square feet, and on the lower side would be 60,000 square feet. And really that sweet spot is probably closer to 100 to 80,000 square feet, because, the amount of supply you build is factors into how quickly you can lease it up and how much you can push rates, and that then, how much risk you're taking, really. Right. So, certain office buildings fit into that, model, and many don't.
You'd think that because storage and office are closer together than housing and office, and office to housing conversions are the ones that are being touted around the country, even though they're much harder in practice. You'd think storage, even though lower rent per square foot than office, I mean, at least up until COVID. Nowadays, who knows, maybe they're already reaching. The way we develop our cities, the suburban experiment, is bankrupting us and endangering our neighborhoods. We face a nationwide housing crisis, dangerously designed streets, a lack of transparency in city finances, endless highway expansion, and huge, wasteful parking lots. But there's hope. Imagine a world where communities thrive, where cities are resilient, safe, inviting, and inspiring. Enter Strong Towns, a beacon of change to challenge the urban landscape status quo. Strong Towns is a nonprofit dedicated to transforming our cities by challenging this broken model and empowering citizens to improve communities. They provide the knowledge and tools needed to tackle these challenges head on. Strong Towns equips you to take control of your community's future, advocating for financially strong, resilient cities. They provide solutions that foster collaboration and generate positive transformation at the local level. Join their network of passionate advocates across the US and Canada. Ready to shape a brighter, more sustainable future for our cities? Visit strongtowns.org. To learn more, go to strongtowns.org. But the reason why I'm bringing this up is because there's a new breed of storage companies, of storage models and subcategories in storage that I want to talk about. And first on the list would be Clutter, the on-demand storage company that had raised over $440 million from VC funds, including Sequoia, SoftBank, Fifth Wall, and recently sold itself for $40 million. That's 10 times less. What's going on? Has the on-demand storage model failed?
Yeah, when you think of on-demand storage, what you're really talking about is a logistics business, because the storage may be the end goal of what you're trying to do, but what really became the difficult part is that you've got to pick up people's stuff, end up dropping it off as well, and then logistically moving it into a warehouse and keeping it there. There's only so much efficiency you can drive out of a person or a group of people that are driving a truck around every day. So, there's limitations on how much output you can get from your crew. And at the same time, people in storage don't stay on average. They don't always stay for 12, 18, 24 plus months. And so when you start factoring in the fact that you have high churn in some of your customers, that becomes a very costly dynamic that, to try and compete at the price point that storage offers, it becomes a very premium product. If you really want to make that business model work, and as price goes up, the number of people that are going to, pay for that service goes down. And ultimately, I think that's what they found, is that the economics don't work, because your average user, you can't just find the people that are staying 18 months, because you don't know if they're going to stay for that long until after they've stayed for that long. So it's not like you have the ability to select those tenants that are going to be staying for longer. So you've got this natural high cost customer that's coming and staying for 6 months, and it just further, creates this dynamic that you really need even longer customers on the other end to counteract that. And it's just this treadmill that's impossible to keep up, because it gets faster and faster and faster. And, separating the idea that, like, you have to educate a population about a completely new product, and there's a trust factor, and you're going to take your stuff, my stuff where, you know, it became a
look. Uber for everything was not and is not a good concept when it comes to venture backability. Edward, you and I have discussed
exactly what I was about to bring up, Jeffrey. Yes, I want your take on that.
With Zach. Look, Cory, we're venture capitalists. You know that. You know my cousin, my partner, and we have to look at the unit economics and not just the sizzle from the steak. Mm-hmm. And the idea of clutter, et cetera, is pretty interesting, right? But everyone here, I think, is old enough to remember some of the models that when we were in college, like Urban Fetch, and there was one that started with a K that on Cosmo.com. Do you remember that? Mm-hmm. And where they would deliver you anything. You could get a VCR delivered. I remember I actually got a VCR delivered in college. That's how old I am. And the idea that this was scalable for venture funding was foolhardy because it was predicated on humans. And until you figure out a way to eliminate the humans necessary to make the logistics more efficient than the traditional businesses, funding at the $400 million level and then assigning valuations that are untethered to reality just doesn't make much sense at all. And I think that's why they ended up selling at the price they did.
Yeah. There was one model. So Closet Box was one of the operators that what they tried to do, because Clutter was an asset heavy business model. I mean, they own the trucks, the people work for them, they own the warehouses, which, you know, the unit economics were just insane of what they had to achieve. Closet Box was trying to use existing moving and storage companies and basically contract with them and then take a margin on top of that. That dynamic had an interesting element to it because it really was like Uber in the sense that you were trying to further take existing assets and then increase the utilization on them versus Clutter. It's like you're buying new assets and just trying to maximize the singular purpose of the utilization for the purposes of delivery of self-storage or pickup and demand. They folded, I think it was 17 or 18. And when you saw that they couldn't make the unit economics work, for me, that's when I knew that Clutter, MakeSpace, all the rest of them were really doomed because they were even further down the pike with having to, you know, fund their own trucks and their own people and everything else. So yeah, it just doesn't work.
For those not familiar with Clutter, they used to or still do pick up your stuff from your home and drive it to a warehouse, usually outside of town. And whenever you need to access your stuff, they'll deliver it back to your door. Now, as if last mile delivery unit of economics weren't hard already, add the complexity of transporting heavy items in and out of a city. I mean, not VC backable returns at all. And Jeff, I want to get your take on this. I mean, among the investors here, there was SoftBank. I mean, SoftBank, Uber. I mean, they know what last mile delivery, how hard that is. Were they just doubling down, or were they like? What's your take? I don't want you to project their own thoughts, but as an investor, like what's happening here?
Are you asking me or Cory?
Jeff, the VC investor.
Yeah, I think that, so I can't describe the motivations of any of the investors because I wasn't in the room. But when you look at SoftBank in particular, and this idea that they had $100 billion to deploy, whatever they wrote into this company, I don't know how much it was, but that was probably a fraction of that. And so they might have thought to themselves, this is an interesting model. And it is. The idea is interesting, right? You have to separate the idea from the applicability. And no, it is an interesting idea. I love the idea of dialing someone up on my phone, come here, I'll put stuff in a box, take it away, right. I don't have to think about it. I love that idea. Right. I'm a busy person. I do not like
especially in New York City. Yes.
Right. But I just don't think that the unit economics didn't make much sense. It was being subsidized by venture dollars. And then ultimately, like Cory said, you had a essentially diminishing return on each person that you're getting in, because at some point, most of them are going to matriculate out. And so I I don't know. I think it was just they thought, well, this is a logistics business. Uber is successful, but Uber is a logistics technology company. Clutter was not a logistics technology company. They were a logistics company that was asset heavy. And so I couldn't tell you what the motivation was. I honestly do not know.
Pretty sure they don't know either. Talking about asset heavy, let's talk about some asset light or asset medium models. Neighbor.com, the peer-to-peer storage marketplace, they have units in all 50 states. I think still the only storage operator who can claim that. Full disclosure, I was part of Neighbor in between 2020 to 2022, building their commercial real estate side. I want to get your take on Neighbor and this, Airbnb for storage models, Cory.
When you go to store your stuff, there's an element of, what matters most to people is security and safety. And when you think about what they're trying to convince people to do, there is a cohort that'd be willing to take a lower price and like the idea of, hey, I'm utilizing some neighbor's space to, their garage to put my stuff in. But if you think about the TAM, the customers that are willing to take that jump, that's not the majority. It's the minority at best. In addition, you have to educate the population when you're bringing them in on the top of the funnel, which increases your customer acquisition cost. And so I don't know much about their economics. Obviously, they're asset light, but it's going to be an afterthought as it relates to storage because there's no scalability around, trying to convince people that, on the margin, you're not, you may save some, but on the margin, are you really, there's a convenience factor. I want to come and not have to call the person and make sure they're home. And who is this person? And they could go through my stuff. Yeah, maybe there's ways that they've gotten around that, but there's just so many questions I would have as a user of that. You could say that my view is tainted because I'm building self-storage, but if it made sense, I'd go and do it and we would have pursued it ourselves. It just doesn't make sense to me.
Interesting. So you say security and safety as decision drivers for renters. I would add location and price, right? I according to some of the research we made, I don't think most people don't rent a self-storage unit more than 5 miles away from where they live or work, and they're also price sensitive. I think what traditional self-storage has really, really nailed is the experience, as you said, and also the homogeneity of the supply. You know what you're getting, and you don't need to coordinate with anyone. In most cases, however, in terms of location, I would say some self-storage facilities do tend to be either in the outskirts or of town or on the side of the highways. So location-wise, and we're talking here about not only potentially homeowners renting out unused space to their fellow neighbors that are looking for self-storage or vehicle storage, but also potentially commercial real estate properties that aren't self-storage that may have unused or vacant space. They could potentially take advantage of that. What's your take on commercial real estate asset classes such as malls, office buildings, even multifamily that have unused or vacant space for them to monetize it through self-storage or vehicle storage revenue?
So it sounds like what you're saying is converting vacant malls and multifamily, those sorts of assets for self-storage?
Could be converting or could be using existing space as is. Yeah,
Yeah, I think you run into the same issues around trying to educate your customer base about how this product is at least on par or superior and worth them taking that incremental step of using something that's, even more unfamiliar to them. I don't see much, legs in it, to be honest. There may be a cohort of people that are willing to take that risk and try something new, but it's a small market. So I don't see much real secular risk from that business model ever really having legs because of the structural, problems around how people think and getting them to do something that is just, in my mind, kind of out there.
Right. No, I think it's not a threat to, traditional self-storage in the sense that, again, we've seen how sticky it is. Customers are sticky, and people will probably not be able to guess what they have in their storage unit, even though they're still paying for it, as we spoke earlier. Last of the new models, which is kind of connected, Stuf storage, or the WeWork of self-storage, where they're master leasing commercial real estate space, putting up the CapEx and collecting rent until they recoup the CapEx, and then they split with the property owner. So if you have a restaurant, a vacant basement, or any other space, Stuf will come in, renovate all your space, and put in self-storage units, and then split the revenue with you.
Yeah.
So I really like this model, and the founder, well, one of the founders I'm good friends with. He's a quiet founder, but the co-founder CEO she is a boss. My challenge is this is still very much an analog business, and I believe that they're raising on venture valuations. But I actually really do like the model, and I happen to know I've seen some of their facilities. They do a great job.
I think that's accurate. They probably do the nicest storage units out there. My question is, if they do the nicest storage, they also need to charge like that. Now, going back to Cory's earlier point, is there a lot of people out there? Are there a lot of storage renters out there that are looking to pay premium top dollar for a place to store their items, where what they care about is mainly security and access?
Well, and to Jeff's point is like, it's still, it's not, there's only so much tech you can incorporate into this business model, and the issues around scalability, just with, let's say you find a 20,000 square foot, office or former retail space, we build at least 60,000 gross in order to make the economics work, because you need people to empty out units. You need people to, do logistical things that happened around these facilities. So as you scale, even in a tight city, say you had 20 different locations, like now you've got a whole operation that you've got to create around just managing these things. Again, to your point around how much you'd have to charge and to make those economics work, now you're talking about a high-end sliver of the market, which there may be a business model around, but I still foresee it's kind of the same issue, just a different approach to it, that it's going to be very difficult to get the scale that they need, number of customers they need at the price point that they're going to ask for in order to make it work as a real, good use of investor capital.
Yeah. I mean, I can tell you that at least during my time, we were able to add supply from commercial real estate owners and operators, not only small businesses, but also publicly traded REITs that had unused space, either in their parking lots or in their interior spaces, and they could generate revenue month to month. It's almost a why wouldn't they, right? At least during lease-up periods or even during development. If you're doing a gut renovation, going more long-term with Stuf, I think that's an interesting play, but certainly you need to make sure the incentives are aligned there. I do think, however, there's a lot less regulation risk, about using storage within your existing commercial real estate or even home, unless you have a very strict HOA, or unless you happen to be working with the selectmen of Saugus, Massachusetts. And I'm not mentioning that for any particular reason. Anyway, Cory, let's move on. A couple of storage subcategories that have popped up or that are becoming more popular in recent years: outdoor industrial storage, cold storage for perishable items, even boat and luxury car storage. Are you looking at any of these subcategories? Are you bullish on any particular of them?
IOS, so industrial outdoor storage, is on fire. Basically just taking a plot of land and putting a fence around it. I'm not close enough to the product, and quite frankly, don't understand what the barriers really would be. It doesn't seem like there would be many barriers. So while there may be a high amount of demand in the near term, investing in it long term doesn't interest me, to be honest. There may be offshoots where we find an opportunity to do it, but there's no scalability to that model in my thinking. Boat and RV, luxury car storage. I like that model. I think as we look out into the future and in this world where people are working more at home and in a remote situation, like the luxury car storage could turn into more of a space that's unique to a person, where they have the ability. It's almost like using an industrial space, turning it into kind of an office / storage / just get away from your house sort of dynamic. There's something there that I think that makes a lot of sense. And so, we're looking at that. Boat and RV, there's a lot of demand for boat and RV. HOAs don't like RVs sitting in front of homes, and there's something to be said for that. And that's something that we try and incorporate to some of our facilities. Building it just for boat and RV, it's not a path that we're going down right now. But, the pandemic created a lot of RV demand. And so there's a lot of RVs that are looking for homes right now.
Another thing uniquely American, RVs. And I was not fully aware of how the RV proliferation until I moved to Salt Lake City a few years ago, and then everyone had an RV. I haven't seen a single RV inside New York City. Anyway, Cory, you've been very, very active on social media, and I mean that in the best way possible. You've been creating some, first of all, sharing, building in public, right? Investing in public. I think you're sharing your insights, you're inspiring, and you're also attracting investors to join you on the journey. Talk about the importance of content creation and thought leadership for commercial real estate players.
Yeah. I mean, if anybody's active on Twitter and has seen, guys like Strip Mall Guy or Nick Huber, as we think about building a brand online, you not only attract customers, but most importantly, you just build credibility at scale. People know you, people understand you, you naturally attract people that want to do business with you. They feel like they know you. You can create value for people that ultimately they'll never become an investor. And I find that to be one of the components I like a lot about it. But I tried for 5 or 6 years. All right, I'll post every 2 weeks, and it just kind of fizzled out, and finally got to a place where I was going to do it every day for 6 months, see what happened. And the first stuff that you post, I mean, it just goes out into the ecosystem and no one reads it. But it's like everything else. You do it enough, you start getting a little bit better at it. You figure out like what resonates with people, how to share your story, because, we started a company, bootstrapped it, started a development organization. Like there's a lot of stories you can tell from that journey that resonate with people, that help people, that people are attracted to. And, I've never been a very public person, but just decided to go down the path of what would happen if we did this? Because ultimately, as we think about, we're building another software product. It's a property management software. Like, as you think about building other things in the future, if you already have an audience, the dynamic of how businesses are built these days, it used to be you build a product and then you go find your customers. And what social media allows you to do is you have this cohort of customers. And if you build large enough for long enough, you already have the ears of everybody. And then once you have a product, it accelerates that dynamic of how quickly you can have an uptake of that product itself. And that, I think, is the future of how a lot of products are going to be sold. If you look at what, legacy brands are doing, they're trying to connect with people on the social side.
Right.
Because they have instant credibility, instant scale. I mean, who was, I'm forgetting his name, but that, sold his wireless stake. He's the actor and has the
Mint Mobile.
Oh, Ryan Reynolds.
Yeah, I mean that's the model. He took a defunct soccer team, and just by pushing the eyeballs towards that team, it creates instantaneous, enormous value. Now, I'm not Ryan Reynolds. Don't have that scale, but no one in the storage space is really doing that. So I saw an ability for me to say, like, listen, I can educate people on what I see, what I know in storage, and create a little niche of a following to where, everything I do is within the storage space. So, there's real value, I think, that is worth putting in the time for. And it's painful. It's painful to create content in my own, it's not something that comes natural to me, but the more you do, like you do anything in life, the more you do it, the better you get at it and the more you understand it. So, to anyone who is building a business or wants to build a business or is doing anything, any niche product or large, well-known product, building a online social media presence, I think is one of the most important things you can do.
We're social creatures by nature. We've never had the opportunity to connect potentially with the entire world from one tweet or from one post.
Yeah.
So it's, on one hand, it's normal to get, paralysis on what to share, or social anxiety after you share something, if it performs well or not. I do think there's a net negative, if you are chronically every single hour of the day online. However, I think it's almost as bad to not ever post anything out there, because the downside is minimal to zero, and the potential upside, if you do it consistently, if you compound as you've shown, I think there's tremendous value to unlock, and it's quality over quantity at the end of the day, right? You don't need to have millions of followers, as long as you're focusing on your niche, you're connecting with people that stimulate you and that you want to learn from, or that you want to work together.
Yeah, I'd ask Jeff, because he's in the space where he's putting money to work, is what have you seen, and how do you think about, all right, you got a founder that has a following, and is that a factor when you go to investment committee of saying that this is an important piece of the equation, or has it not made its way into thinking about the potential success of a product that you're investing in?
It's a component, but it is not the driving factor. The driving factor is how talented is the team, how talented is the founder. And that's something that we're quite good at gauging. And I think social is difficult for me because I do not have a social media presence aside from LinkedIn. I have a lot of anxiety, specifically for my children, around the prevalence of bad behavior and bad actors that social media fosters. And so I have not indulged or engaged myself. And yet when I do find it useful, and I do find it informative, and I do find it entertaining. And so there is, at least for me personally, there's this dichotomous reaction I have when I see, like we talk about Ryan Reynolds, we're now in a celebrity-driven world. And so celebrity-driven products and services often get top shelf or more attention because of the celebrity, and not always because of the quality of the product. And so in our industry, in real estate, it's less important. What will be interesting is there are obviously real estate social media. I'm going to use it. You can't see me, but I'm using my hands and air quoting stars, and seeing how they develop their businesses and extend their businesses beyond, let's say, brokerage or development or whatever they're doing, software development, I don't know, and creating multiple verticals using the fact that they've been able to leverage their social media celebrity and get reach that other people can't, because reach really is an important component. Marketing is an important component. If you can market for free or close to free and do it at scale, that's pretty powerful. And I remember when Zuckerberg, using his last name like I know him, bought Instagram for $1 billion. And I remember reading articles saying, he doesn't know what he's doing. This guy shouldn't be running the company. And I remember saying to myself, no one knows what they're talking about. This is the most important, impactful invention. I mean, you think of what Instagram has created by itself. It was worth 100 times what he paid for it. And he knew it. And so I know this is a long, winding answer to a question you didn't really ask, but yes, it's something that we look at, but it is certainly not a core component of driving our investment thesis.
Understood. In the 6 months I've done it, we've had sites that have come to us. We've had endowments that have come to us.
Using what channel? Because I'm now going to, if it's LinkedIn, I'll follow you.
LinkedIn has been, 3 or 4 months. I started on Twitter with nothing. And, that was the original premise, because the idea is, okay, I was having a conversation with one of my partners and he said, if you really want to, I was in this kind of mode where, all right, I'm just doing things. If they're difficult in my life, that means that and I've shied away from them because of the difficulty. It's something I need to do. And on the business side, the conversation that we were having was, okay, well, if you really want to do something that's difficult, do a newsletter every single week for a year. And I was like, that's what I need to do. And the thought process led me down the path of, I first need an audience before I start, writing newsletters. And so that's where I said, okay, well, I need to start at the top of the funnel with LinkedIn and Twitter. And
so how did you build your Twitter following?
Just started talking about my journey, what I've done,
But did you start it? Because this is interesting for people that are listening, founders that are listening and trying to say like, well, I don't know how many Twitter followers you have, if it's 1,000 or 1,000,000. I have no idea. Although I am going to look it up. Did you start with 1,000,000? Did you start?
No, I started with 200. I mean, I'm at 10,000 right now, but I started with 200.
Well, 200. How did you start with 200?
The first tweet I did is the one that's pinned on my profile, is just like, here's my journey into self-storage, and talking about how we shorted the stocks and found that no supply no supply data set existed, and here's how we solved the problem. And what people on Twitter are attracted to is they're attracted to people that have done things. And not to say that what I've done is that miraculous, but within the storage space, there's interesting things that we have done in terms of being able to create value, and how we've done it and how we thought about it and what we originally were trying to accomplish. And, people love when I post, this is a building that we're building and here's how we found it. And here's how we think about rates, and educating people that either want to invest in storage, don't understand storage, or building storage themselves. Like, they are attracted to the story of, all right, this is how this guy doing it. I can follow along and feel like I can glean information, or just it's an entertaining source of.
You know what? You have just inspired me. We have talked about this a long time. Edward, I want the record to show. This man, I'm going to create a Twitter account or an X account, whatever it's called now. And the first person that I'm going to follow is this man right here. And then I'm going to look for you. And then I'm going to look for Zach Aarons. And at some point, I'll probably tweet some. What's the right verb now?
Yeah, you just tweet. You're still
Cory,
just tweeting.
But it's not Twitter.
What have you created, Cory? I feel Frankenstein, the Twitter Frankenstein is being born here, and I cannot wait for Jeff's journey on X. And that's
I'll be your first follower, channel. Jeff.
Oh, I'm so excited.
Are we doing this live?
It's painful, but ultimately, like, Jeff, you guys have started a VC firm, created a ton of value. All the company stories that you guys have, like, figuring out how to extract that out of what there's a process of figuring that out. And like your first line is 90% of it, because either people find interest in what you're telling them or how you're leading them on, and then ultimately what the story is. So there's definitely art that you'll learn along the way. But on the VC side, you tell your story, you start talking about what you're doing, and over time, founders start coming to you. And it's this top of the funnel dynamic. And don't expect it to take off in 3 weeks. But if there's a consistency element to it, and there's a thought around the stories you're trying to tell, and if you start, I always try and think about, and it's difficult to always do this, is like, what value am I pushing out on this? Am I just trying to project success, or am I trying to project value? And what I found is when you try and project value and authenticity, it resonates very, very well. And you top of the funnel just grows enormously. And I've found it to be, if there's one thing I could have done earlier in all my businesses, it's really focused on doing this 4 or 5 years ago, because I have in my head, it's been 6 months, 10,000 followers, I'm up to, I don't know, like 6,000 on LinkedIn. But if you continue to do it, it compounds. And, I can get to 100,000 on Twitter. I can get to 20 or 30,000 on LinkedIn. And then think about how that works when it's, you're talking about a new product, or you're just talking about your story, and people naturally if they like you, they're attracted to you, they come to you. It's the most amazing phenomenon that I found a lot of value in. But there's this, going back, Jeff, to what you said about, kids and social media. My kids are 7, 5, and 3, so I haven't had to deal with this yet. But there's an inevitability of like how to use a gun responsibly, that it's like you can keep kids away from guns, or they can understand like the danger of it and how to properly handle it and what to do if they ever see it and things of that nature. And that's how I think about social media, is that it's this weapon that if some of the stuff I did in high school and college was posted on social media, like I would not be around today. And that's the piece of it where even in my own life, like I have to try and create barriers to it, because it can become something it's so consuming. So it's a lesson in discipline a little bit, but ultimately, like, yeah, it's there's definitely that scary element of it where, it can become this monster. But, if you approach it with the right mentality, and it can be a really powerful weapon.
I think two important points before we move on to the last section that you mentioned: authenticity, right? I think people know when you're being authentic, but more importantly, at the end of the day, everyone on social media, including people that want to learn about commercial real estate, about prop tech, we're looking for two types of content, and only two types. One is insightful content, your smart threads, and entertaining content. So your dumb memes. That's all there is. And I think Cory has found a formula to provide both insightful and entertaining takes about his self-storage investing and startup founder journey. So I encourage you to follow him on your favorite social media platform or his newsletter. Cory, collaboration superpower. If you would have to choose one person, dead or alive, to do a partnership with, to do a collaboration with, who would it be?
Collaboration. I mean, I love Elon Musk. I'm not on his level, but he's just brilliant. And the way that, I haven't read the book that just came out, but understanding, some of the excerpts I've seen, his intensity at approaching work and problems and his brilliance would be something that, I don't know what we would do. I don't think he'd be interested in anything in the self-storage space, but to the extent you collaborated with somebody like
surprised.
Yeah,
you would store some of his chips.
He would have the smarts to develop the model to create the solution for your problem. So maybe I don't want to collaborate with him, but no, somebody like that. I mean, how can you not? You can have issues with how he thinks socially or in any number of regards, but what he's done from a business standpoint, from my vantage point, is just like it's just amazing. So working with somebody like that, who's so much better than me, would be I get huge value out of that.
Cory Sylvester, where can listeners find you and learn more about DXD Capital and Radius Plus and your upcoming property management software company?
On social media, my username is Storage Data Dev. I'm on LinkedIn, Cory Sylvester. DXD.capital is our website. RadiusPlus.com and manage.space are all the websites for the products. But and the other thing with Twitter is people reach out and you have a lot of direct messages with people. That's where half the value is on these social media platforms, is actually talking with people and interacting with people that otherwise you wouldn't be able to. So people want to talk, have questions, I try my best to respond and have those dialogues.
Community, all about the community, and community-based businesses will win in the future. Cory Sylvester, co-founder and principal at DXD Capital. Thank you so much for coming to Tangent today.
Thanks, Edward.
Jeff, want to say goodbye?
Oh, yeah, sure. Well, actually, you know what? I do want to say goodbye. Cory, thank you for inspiring me. I am going to sign up for Twitter. Hopefully they'll let me follow you first, or I might have to pick someone to follow first, and then you'll be number 2. But this really is a sea change for me. We'll see if it sticks, Edward, at our next tangent. We'll see.
We'll check the progress.
1 follower, or do I have 100, or do I have
keep
1 follower?
It's up to you, Edward. It's up to you.
Keep ourselves accountable. If Jeffrey gets banned or suspended from X, we did not have nothing to do with it. We're bullish on you, Jeffrey.
Oh, fantastic.
Jeff on X. That doesn't mean Jeffrey on X.
Oh, goodness gracious. No drugs for this guy.
If you like what you heard, please subscribe, rate, and review Tangent and share the show with a friend. This episode is produced by me, Edward Cohen. Thanks for listening to Tangent, and remember, collaboration is our superpower. So stay curious and always be learning.